There are three types of companies in the market. Let's see in this video what these types are and why you should choose one over the other. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing, or finance in general. And if you love the subject, please consider subscribing. There are thousands of companies out there, but not all companies are the same, and not all companies can suit our needs and our investment goals. In this video we are going to see the three most important types of companies so that you can choose the better one for you and the better one for your style of investment. But hey, before we start, if you enjoyed the video, please leave it a like and let me know in the comments down below what is the type of company that you prefer. Let's first talk about growth stocks. These are stocks that grow fast, that have a really fast growing revenues and earnings especially, but also they are kind of overvalued, so their price is really high compared, for example, to some indicators, for example earnings. So again, for example, you have a PE that is really high normally, even above 40, but usually above its market average. Also they can even have negative earnings and they can have sometimes high levels of debt. That's because they need to grow fast and they need to use their earnings to grow as fast as possible, and they need debt also to grow as fast as possible as they can. So what you want to see on the fundamental side is a company that grows fast and fast, and if they have a negative earnings, you want to see the negative earnings that decrease faster and faster every year. Also on the price side, you will see companies that are overvalued, that have a relatively high price, but also they move a lot. They can even move 400% in a couple of months, but also minus 60% in a couple of weeks. And also another characteristic is that they are pretty young. You want to see companies 20 years old as a growing company, as a growth stock. For example, you can see Netflix. Okay, yeah, this is a little bit an old company, but nonetheless, this company grew very fast in the last years. The revenues grew very fast, the earnings grew very fast, and also the price grew very fast, because on the last rally, on the last bull run, we had a 400% increase. Now let's talk about value stocks. And these stocks are the stocks that everybody talks about. Have you ever heard about undervalued stocks? You know, buy undervalued and then sell when the value is equal to the price? Well, this is the type of investment that Warren Buffett uses. So the main goal here is to buy low and sell high. Buy at a low price but high value, and then sell a high price and a high value, okay? So when the price meets its value, you sell, and if the price is less than the value, you buy. This is the basic of this type of investment. But also the rise of the price in these stocks is very low. These are mainly heavy companies, stable companies, but heavy companies with much market cap, and they need a lot of money to move. And so they move slowly. They might take even years to get the price to its value. The positive side is of course that they have solid fundamentals. And also because they take time to move upwards, they also normally take time to move downwards. And because of that, the volatility is really low. So you won't have like spikes of 60% in a couple of weeks. Another characteristic is also that they are pretty old. Normally you will see these companies as being 10, 20, 30, 50 years old. Compared to growth stocks, these are stocks that are more safe. Okay, we can call this a more safer investments, because again, the price doesn't move that much as in growth companies. The fundamentals are much more solid. The companies don't have that much of possibility to go bankrupt. On the other hand, we have growth stocks with young companies with not much great fundamentals, even though they grow fast, but they may not have great fundamentals, they may have a lot of debt, they may not have positive earnings and so on, so you have a much more chance of going bankrupt there. Now for our value stocks, we could see Procter & Gamble, for example. We have a more or less stable revenue, a more or less stable earnings, and the last bull run only did 60%. So you see that compared to Netflix, we have a 400% for Netflix, and then we have a 60% for Procter & Gamble. So you see the difference here. And the last type of stocks is income stocks. These are stocks that can generate you an income, a more or less stable income. Through what? Through dividends, of course. On the fundamental side, we have solid fundamentals. We have really old companies, stable companies, reliable companies that we know have a really small chance of going bankrupt. Also, we need to have a dividend history very long. That's why we need old companies, because we need to see if the dividends are reliable. If one year the dividends goes up 10% and then another year the dividend is 1% and then 5% and that's just for 3 years, it's not a really reliable company. We need to see maybe, 10 years of dividends, and we need to see a stable 5%, a stable 10% dividend. And so a stock that can generate you an income more or less stable every 6 months, every quarter. Normally these stocks are valued pretty well. So the price on the stock market normally reflects the value. So you don't want the stock to increase the price necessarily, because you don't care about making money from the movement of the price. You just care about the dividend. And also on the stock market, the price could even drop, but you don't care much, as long as the dividend can cover the loss in your capital and that the dividend can generate you a more or less stable income. For example, I chose Canon for an income company. This is a company that has a more or less stable revenue, more or less stable earnings, and also a really nice dividend over 5%. But also, as you may see from the chart, the price even dropped. Of course, when you do your analysis, you have to see if the price dropped too much, and the dividend cannot cover the drop in the capital gains. Also, we should mention that sometimes these type of companies overlap, especially value company and income company. You may see many times a value company, so a company that is undervalued and that has a decent potential on the upwards, having a really high dividend. So that's an income company and a value company. So you could even profit from the dividend and from the increase of the price in the stock market of the company. And so what is the type of company that I prefer? The types of companies that I invest in? Well, it's growth companies. These are again companies that grow fast, that have a really fast growing income, really fast growing revenues, and also have a really strong potential on the price move, and they can do a 500%, 1000% in a couple of months, maybe a year. And those companies strongly increase your capital and they make a really high amount of capital gains. And so I don't care about dividends. I really don't want the dividends in those companies, because again, I want them to take their earnings and I want them to invest in the company and grow as fast as they can. So this is the company that I prefer. But hey, this was all I had to say for these 3 types of companies. If you enjoyed the video, please leave it a like and let me know in the comments down below what is the type of company that you prefer, the type of companies that you invest in. And I'll see you in the next video. Why does inflation happen? Who influences the level of inflation in the economy? In a previous video, we talked about the fact that we need to use this modern type of money, banknotes issued by a central bank, because we need to control the level of inflation and deflation in the economy. But how do we do that?